There was one other person.
Yes, sir, I'm here.
Okay, James F.A. All right, good. Okay, so I'm going to go into that. But before then, let me just give a recap of what we have done so far. So far, we've touched on data collection. That is the first thing. We've touched on data collection. We have touched on how to get the company overview. Yes, day 4 is intentional. We're going to go over everything again because of the feedback I got. I asked that it shouldn't be put on YouTube yet because I'm going to go over that session again. Okay. So we've gone over how to get the company overview. We've spoken about industry analysis, and we've done some trend analysis. That is where I made mention about the growth analysis. So trend and growth analysis, which we've gone through it over and over. And we've also done ratio analysis. That's what we started. All right. So with the ratio analysis, we are now zooming into valuation. Ratio is also evaluation analysis, but we are going to the DCF sort of. So we are delving into another matrix or another model of valuation. So I made mention that there are some analysts who, after doing the trend analysis, they are able to conclude whether we should buy, sell, or hold. All right. And some others too, after doing their trend analysis, they do a thorough ratio analysis and they can end with that. That is also acceptable. It's also good. All right. We are going beyond all those. All right. We are going beyond the trend. We are going beyond the ratios. We are going to the various other models of valuation. So I made a display of the recommendation I made for GCB, where I touched on the RIM, that's the residual income model. I made some projection, 1-year projection and a 2-year projection based on the growth in the earnings per share. And I also touched on the interest value using the FCFE DCF model. So that is what we want to learn. We want to learn the various models of evaluation. So currently, we're touching on the FCFE valuation model, and there was mention of the cost of equity, and that is where a lot of us felt we should go into more. So let me just briefly go over what we did yesterday. So guide to source and the FCFE DCF valuation assumptions, and then we went through these useful links. Now, the FCFE formula as stated on the screen, you can see. If you can see, you let me know. All right, but I believe all of you can see because I'm sharing my entire screen. So it's the net income plus the non-cash charges minus capex minus change in working capital plus net borrowing, and interest value is also stated here. I made mention that we're going to touch on how to get each of these components for the calculation of all these. So we entered into how to get the cost of equity, how the discount rate. Okay, and yes, so I explained what cost of equity is. So it's a return shareholders expect for investing in GCB shares, and why it matters, I made mention it's used to discount future cash flows to today's value. So this is where the contention was coming from. A higher rate lowers the stock value, reflecting Ghana's. I think this side, a lot of us here, it's a bit tricky anyway. It's not just for you students, but generally in every finance class, this is an area that is very tricky. So I'll delve into it and try to explain it further and see if today's session can help in the explanation. So how to calculate, we have the risk-free plus beta, and then take into consideration ERP. All right, that is market return minus risk-free. Okay, so these are the other components, the terminal growth rate, which I made mention that it is tied to the GDP growth rate of the country. So you can use the projected growth rate of your country, Ghana, okay, or you can go lower so that you're not overly optimistic. So if you overvalue it, it might affect your projections. And the FCF growth rate too, I made mention that it's the free cash flow, the forecasted free cash flow. For my evaluation, I did an average of the first 3 years because I realized that it wasn't stable, it's been fluctuating, and it will affect the growth rate that I'm going to use. So I did an average, and the average figure is what I use as the going forward values. So I pegged it at 15%. 15%. So for future projections, analysts use the industry averages. So I pegged mine at 15%. Risk-free rate, I made mention that there's the safe investment like government bonds, 91-day, 364-day treasury bill, 10-year bond. Normally, there is a 10-year bond rate that is used because that's for the long term. The long term, you use it the long term. So if there's a 5-year, you can use the 5-year. But I chose to use 10% because the 10-year bond is around 9.29. The Ghana 10-year bond is around 9.29. Treasury bill rates just around 10%. And 182, let's say around 12 thereabouts. So I chose to use 10%. And for every valuation analyst, whichever value you use, you have to be able to explain. For the market return, the average in the last 5 years per calculation was 30.10. However, I chose to use 25%. I didn't want to be too bullish about it because the country is not immune yet from all the risks within the environment. So in that one too, I chose to use 25%. So as you can see, is expected return of the overall stock market. So if you do the average, you expect that if in the last 5 years, average of the GSC has returned about, let's say, 30%. Going forward, you don't expect it to go maybe below 25%. So that's how come I chose to go the 25%. Beta 2, I'll do a presentation today on beta, go deep into it so that we understand the outstanding shares. I showed you where to find outstanding shares. Okay, so that you can get the intrinsic value per share. The forecasted period normally is for 5 years. How to use it? Standard 3 to 5 years. In Ghana, if you project over a longer period, the likelihood that you'll not be given very good figures. That the Ghana market is very volatile, and it responds to shocks from everywhere globally. So normally 3 to 5 years is what we use. Valuation year is the current year. So we made mention that we'll be doing some sensitivity analysis where you try and change some of the rate to see how it will respond in the intrinsic value. So the discount rate, you adjust it upward, downwards, terminal value upwards, downwards. The growth rate, you adjust it to see how the intrinsic value will be. Now, these are the discount-free cash flows. We'll go into it. This is just a snapshot of how it looks like. So calculate the intrinsic value, how to go about them. Everything is stated here. Okay, so with that said, I'll move straight into the cost of equity explanation. Okay, so this is it. Please listen very carefully. Where we are now, it's a bit tricky. So if you don't understand something, it's going to hurt the process. But as I keep saying, there are some analysts who decide to end at the ratio analysis, and that is very, very acceptable. It's okay. Okay, but if you want to know more, this is the way to go. This is the way to go. So first, so understanding the cost of equity a key to smart investing. So the cost of equity is the return. I explained yesterday, but allow me to go over it again. So the cost of equity is the return shareholders expect for investing in the company stock, given the risks involved. We saw it from the calculation. It's not a fixed cost like interest rates. Okay, it's just an opportunity cost. This is a word that I failed to use yesterday. So it's an opportunity cost. What you could earn elsewhere with a similar risk. So in our context, Ghana, as I keep mentioning, there's high volatility. So our market is very volatile. There's a high inflation. Even at the current levels of our 12 is still very high, especially if you compare to what our neighbors are doing. So the cost of equity for banks like GCB is normally elevated because of these market risks. Now, what is cost of equity? So I want us to use the lending analogy. All right, lending analogy. So like lending to a friend. Okay, so a reliable friend, we say is low risk. Okay, so in that friend, you get a low interest or no interest rate. Okay, whilst risky friends, because they are risky, you want to put high cost on them. So risky friends require higher returns. So in the same way, let me use the investing in treasury bill. Okay, because investing in treasury bill has low risk, it's government, it has a very low risk, therefore very low returns. Okay, and because investing in stocks involves a lot of risks, there's expectation of high returns. So shareholders demand higher returns from riskier investments. This formal definition is for those who want to write it in their books for exam's sake. So it's the rate of return required by investors to compensate for the risks of owning a company's shares. The rate of return required. So if the rate of return or the cost of equity is around 23, it is expected that the stocks will earn more than, or at least close to, not close, it should be 23 or more. Because the cost of equity is at 23, the return should be 23 or more. So the rate of return required by investors to compensate for the risks of owning the shares. So for GCB, with the market price of 9.54, I think the last time we checked, it's gone to 0.57 or so. So a high cost of equity might signal risk, but also potential high returns. That's why the intrinsic value came to the 21.1. Okay, that's why it came to that level. So it means that there's high potential for it to rise. You're expecting a higher return from 9 cedis to 21 is very high. So that is the compensation that the investor will be getting from investing in GCB. So for companies, it helps decide if a project is worthwhile. So if GCB's cost of equity is 23, any new loan or product or branch must generate at least 23% return to create value. If the cost of equity is 23, whatever return or whatever income that comes in has to be at least 23%. For investors, central to stock valuation model like the DCF as we are doing, a higher cost of equity means future cash flows are discounted more. So like we saw in the Excel, let me open the Excel. Okay, so I tried with these. Let me use the new Excel sheet. So with this, let's say 55. All right, so once the cost of equity goes up, it suppresses the intrinsic value. It means that you have to put in more. All right, you have to put in a lot Okay, and once the cost of equity is so high, it doesn't inure well for business. So even though you'll be expecting more, it suppresses the intrinsic value. So if the cost of equity is around 55, it means the company is so risky. It's too risky. So you have to move away from that company. And normally for banks or for institutions like GCB and those well-managed institutions, when the cost of equity is high, the factors that make up the cost of equity, the perpetual growth rate, um, the 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 beta of the company, all those risks, they form part of the cost of equity. So we have to make sure that we come up with a figure that will not affect our valuation. Please, if you have the question, when we get to that stage, you can ask so that we can make progress to it. So higher cost of equity means future cash flows are discounted more, lowering the stock's intrinsic value, as we saw. High cost of equity suppresses the intrinsic value. In emerging markets like Ghana, high cost of equity reflects risks like currency depreciation, political instability. There's a whole lot. The only thing with this discounted cash flow model is that it doesn't factor in the political and those other qualitative risks. Yeah, it doesn't factor in those risks. So that is the issue. And it also assumes that the cost of equity remains stable over a long period of time, which is, practically we can say is not possible, because for institutions, for countries like Ghana, which we know the system is very volatile, cost of equity cannot remain around a similar level over a long period of time. There is fluctuation, with even the banks, the risk of NPL is so high, and it's as it comes up as and when. Every period and its own issues that come up. So the banks, as if you realize, their working capital too, it's quite an issue when we go year in, year out, and it's not something that is stable. So cost of equity dynamics factors in all these things. So it is not realistic that it's going to be stable over a long period of time. Yeah, so for us to factor in the proper cost of an equity, you have to use some experience in the market. You have to align it with your understanding, or you have to consult. That's why we keep saying that the equity risk premium, you can pick them from trusted sources. I made mention of one source. I'll pick up the name and share with you again. So if you don't understand, you can call me anytime. You can call any qualified analyst. You have a discussion. Normal evaluation is not done by just one person sitting in one corner, right? It has to be a discussion. There has to be an agreement. You discuss and then you pick points here and then. That's why we are encouraging that you work in groups. You work in groups so that you will be able to be well informed when you need clarifications to some stuff. Okay, so the main point is that higher cost of equity means future cash flows are discounted more. So as you know, as I've shown to you with the DCF model, is the future cash flow that is discounted to current valuation here. And when you do that, when you apply a high discount rate to a future cash flow of an institution that is well managed, if you're not careful, you suppress the cash flow or the intrinsic value, and you may not get the real intrinsic or the fair value for the institution. So let's look at what happened in Ghana in 2023. During Ghana's 2023 economic challenges, inflation was very high. I think it rose as high up to more than 40%. So banks' cost of equity rose, affecting stock prices. Within that time, stock prices too, they were not too looking good. The cost of equity were very high. Some of the stocks rose basically because they rose basically because treasury bill rates or bonds were not doing so well. So our investors wanted to try those other investments, and they think they got a reward from investing in those investments as well. So what we are saying is that strong profits lower the cost of equity. When the cash flow is strong, when profitability is good, it lowers the cost of equity. Now, this is the formula for cost of equity. So in all the explanation, I've made mention that there is that risk in there. There's that risk in there. So in this case, we are measuring the risk-free rate. We are measuring beta. Beta 2 will go into it. We are measuring a whole market return, that's the stock market return, average over a period. And we are still looking at the risk-free rate. So the equity risk premium, that's the ERP, how much you are earning, okay, market return minus the risk-free rate. The cushion between the two is what the equity risk premium. So whilst you are not doing treasury bills and you decide to go and purchase stocks on the market, the premium or the cushion or the income that you earn, comparing the two is what we call the equity risk premium. That's the risk. That's the risk you are trying to stomach to buy into the equity market. So market risk minus risk-free rate. So whatever you get is the premium. All right. So it's all risk here. Capital asset pricing model, the cost of equity. So let's say the risk-free return on safe investment like Ghana's treasury bill. These are some of the rates examples, as you can see on your screen. Beta measures JCB or the stock's volatility relative to the market. Okay, so with JCB, with the report I did, I pegged it at 1.3%, even though the calculation over the period brought out the result of 1.44. Market return, expected return of the Ghana stock market, 25 to 30% based on the GLC or share index historical return. So based on the historical, all right, you pick an average, you can use that average, all right? Or if you don't want to be over bullish or optimistic, you put it at a level that you can explain. Okay, all these things is about how to defend, how to speak to them. But if you don't want any issue, you just pick the figures as they are and just say realistically compare the values. This is how it's supposed to be. However, you can go the other way. However, when you do your sensitivity analysis and you reduce market return to 25, this is how the result will be. If you decrease beta to, let's say, 1.2, this is how the figure will be. If you change the risk-free rate to a certain figure, this is how it should be. So you have to be dynamic in your calculations. Now I chose to do an example. All right, so risk-free rate, beta, market return, expected market, the ARP is 15%. So when you compute the figures here, you are getting 25.63. Okay, but the valuation I did, it was 23.08. You see, I'm not saying that during the beginning, I think at the beginning of the presentations, I made mention that you shouldn't say somebody is wrong. You should rather ask what approach did you use for your evaluation? What are the assumptions you used? Okay, so these things, they are very important. So you can see team A getting an intrinsic value of, let's say, 55. Another team is getting 45. Another one is getting 30 something. So you can't just jump into conclusion and say you are wrong. It's the approach, how you go about it, and the assumptions that you use. It has to make sense. It has to make meaning. Okay, so this is what this example, the cost of equity came up to 25.63. These are alternative calculations or formulas for the cost of equity. You can use the dividend discount model. That is a formula for it. And because our stocks in Ghana don't really pay dividends, really we don't want to be using it. We can apply it for MTN. Right? MTN is very solid in dividend payment. This is another approach. We're not going to use those ones. I think the DDM is one approach that you can use, dividend discount model, to calculate the cost of equity, or we can use the CAPM. So some factors affecting. Okay, before I move here, let me just open here. We have the cost of equity calculator here as well. Yeah. Yeah, so the cost of equity, you can see I applied two models are here. So the DDM and the CAPM model. So risk-free, let's say 10, beta 1.3, market return 25. If you decide to use dividend and the DDM parameters to dividend per share, let's say it's 1, current share price 9.57, dividend growth rate, UCB, you see it's very difficult to tell. So let's say let's put it at 15. No, 15 is too high. So we can put 3. Then the weights that you want to apply. So CAPM, let's say 60, DDM 40. So as you can see, CAPM came up to 29.5. I think it's close to what we have in our presentation. Okay, this is 10, 1.325, 25.63. Okay, I think there's a variance in there. So this CAPM is 29.5, the DM is 13.45. So you have to just be changing. So if you say, let's say use 100% for CAPM and 0 here, so it means your weighted average will come up to the figure of the CAPM 29.50. Okay. So this is it in case you don't want to apply the Excel calculation and want the easier way. This is the platform you can use to calculate your CAPM, DDM. So for example, for the stocks that don't pay dividend, you just put 00 for these 00. Okay, and leave the CAPM at 100. Then you see there's no figure for DDM. If you want to just fully use the DDM parameters to it, you just put 0, let's see 100 here, and 0 here. Let's see how it will be like. So you see, because it's only CAPM that has figures, the weighted average comes to 0. So you need to put some figures in the DDM. Dividend per share 9.57. 15, let's say 15. Okay. And you put 0, 0, and 0. Okay. It requires that you put in. Okay, so you come to 14.45. So this is one place that you can get evaluation done. Now we move to factors affecting the cost of equity. We mentioned economic factors. There's a whole lot. So high inflation affects cost of equity. If you really want to calculate the cost of equity, all these things, they affect it. So we know that beta affects it. We know that the market sentiment, the ERP, Ghana's recovery from 2023, debt crisis lowest ERP slightly reducing cost. So these are the factors that affect the cost of equity. I'm going to share the slides with you, so don't worry. So practical applications in valuation in DCF models, high cost of equity discounts future cash flow heavily, given lower intrinsic values. Okay, so if ECB's expected return is higher than cost of equity, buy the stock. if GCB's expected return is higher than the cost of equity by the stock. So at 9.54 with a value of 21.11, it appears undervalued. Okay, so this is the real scenario that I applied in my analysis. Limitations are that CAPM assumes markets are efficient, which is not always true. You know, our market is very volatile and doesn't capture all risks, example, political. And use the sensitivity analysis if beta rises, like those things that I've mentioned. Now, the key takeaway is cost of equity is the hurdle rate. Okay, is the hurdle rate for stock investment, and understand it to make smarter decisions. You need to ensure we understand it. Is the hurdle rate for stock investors. So if the cost of equity is at a certain level, you make sure that you are getting more. If it's too high, you don't need to go for it. Okay, but as an experienced analyst, you need to find a way to massage it to ensure you're getting a reasonable cost of equity. And you have to stay current, practice calculating the CAPM, and check sources like the Bank of Ghana, Daran for fresh data. The Daran, it puts a lot of data out there, so it's an area that you can look at. So I think this brings me to the end of the cost of equity presentation. Let me just recap briefly. So it's like lending to a friend. You get a low or no interest, a risky friend. Whilst when you are giving money to a risky friend, you expect a higher return. Okay, so shareholders demand higher returns for riskier investments. And the returns or the cost of equity is too high and it's suppressing the cost of equity. It's suppressing the future cash flows, then it's something that it's a concern. So you have to take a look at it. And all I'm saying is that the rate of return required by investors compensates for the risks for owning the shares. If the cost of equity is 20, when you buy the stock, you should earn more than 20% or just 20, at least 20% or more. When the stock market is giving 9% and so on, ensure that you're getting 20% or more. So I'll pause here to take questions. From the two guys who asked the question, I want you to come first so that we can proceed. Have I broken it down enough? Gio Kobe, ask your question.
Yeah, hello.
Hi,
Good
Gio.
morning, sir.
Good morning.
Thank you for the clarification. I was the one who asked about the equity yesterday.
Okay.
And there is this question that's bothering my mind about the same thing. Is the percentage that the shareholders expecting, will it be on the dividends or the capital appreciation of the stock? And then the second question that I have is you say from the slides today, you say the Ghana stock market is volatile, but quite recently, MTN announced that they would they are trying to make Momo or give Momo to a different company so that Ghanaians will own about 30% of the shares of that's the Momo transaction. But it seems I per se don't know the company who is going to owe, and I don't know if any other person know. But if it were to be any other market, maybe the stock value of MTN would have been on hold for a little bit. So that changeover happens, and then we know the company. But still, the company still, that's MTN shares still keep soaring higher or still keeps on being bullish. So I want to understand the volatility in this essence. Yeah.
Okay, so let me start with MTN Ghana. MTN Ghana it's a very mature institution. It's a company that, even though it has a beta of more than one, you can say that it's a very assured area of for returns. So, with the intention of the institution to give Ghanaians the opportunity to own a portion
Yeah.
of the stock, because MTN has a very good track record, a very good history of returning high to investors, there's still the high expectation. Whatever the
Okay.
situation, there's a high expectation. So investors that are not already shareholders, they are still rushing to be shareholders.
Okay.
They're still rushing to buy the stock. And there are a lot more too who have earned a lot. So MTN listing at 75 pesos in 2018, I think 2019 or 2018. If you were a shareholder since that time up to now, it's a lot of money.
Yes.
So some are diversifying, they are moving out and coming in, that kind of thing. So every time you enter, even now that valuations are showing that the books, it may be overvalued. There's a lot more people who are entering because the market
Okay.
expectation is very high and it will keep rising. So until the transaction is sealed, the expectation is that once you are a shareholder around this time, you become a shareholder in both sides, both the Momo and the communication side.
And then
So
yeah.
as investors taking positions, high expectation, they know MTN won't fail. They know people will continue to make calls, people will continue to buy data, people will continue to use Momo, people will, like it's a whole lot. It's a big business that company is doing. So it's the high
Okay.
expectation of investors that is making the stock price continue to rise. The volatility I'm talking about, generally our market is not very stable.
Mhm.
It's not very stable. We saw what happened to the financial sector not too long ago.
Yeah.
All the banks, almost all of them were exposed to government instruments. So when those instruments were touched, it affected their profitability. And institutions like Canva, they are still recovering. An institution like Canva, for example, they're still recovering. And with the manufacturing companies like Unilever and the farm milks, when COVID came in, there was high interest rates, there was high depreciation, and those are the factors that affect those companies. So volatility, yes, because when these factors come into play, it affects their operations and their
Okay.
profit. So that's why we are saying that it may not be prudent to do a 10-year analysis. If you just relax on between 3 to 5 years, then you can be comfortable with your valuation results. Yeah, so
Okay.
volatility cuts across the board. Okay. Now, I'll move to the capital appreciation part, whether it's based on the capital appreciation on the dividend. In calculating the returns of a stock or a company, so as an investor, what are you looking out for? You're looking out for dividend payment. You're looking out for capital appreciation. These are the two things all investors look out for. Okay, so we don't just take one. It is the two put together.
Okay.
So, in fact, when you're calculating the capital or the return that you've earned on your investment, all right, when you do the current price minus the previous price, let me open this page for you. There's another, I don't know whether it still works. Stocks. So you click on stocks. This is the very first one. The very first one. So this is a capital gain formula. Selling price minus the purchase price. So it's the same formula that we've been discussing here. So current minus previous over previous times 100 plus, then you consider the dividend yield. All right. So let's say you have 5,000 shares of, let's say GCB is 9.57, and your broker takes a commission of 1%. Selling price, possibly maybe sold it at 12 cedis. Okay. And the broker takes another 1% dividend. And you see, there's dividend here. Takes into consideration dividend. So probably you earn a dividend of 200 cedis. What you calculate? All right, that is the capital gain. So investment
is not sharing. Yeah.
The screen is not showing.
I see the screen.
You see the screen. Can you all see the screen? If you can see the screen, let me know. Okay, then I'll proceed. So I mentioned that capital gain is the selling price minus purchase price divided by the purchase price times 100. That is the growth analysis that we've been doing. So we can see that it applies to this side too. All right, dividend yield to dividends divided by purchase price times the number of shares times 100. The total return, that is also stated there. So for example, you buy 5,000 shares in NIGCB at price of 9.5%, 9.56 purchase commission. The broker takes 1%. Hello. Hello.
Please, are you sharing the screen? Yes, are you sharing the screen? Because I can't see the screen.
Yes. So I'm sure it's your network, but I can see that it's being shared. Who else can see the screen?
I'm not seeing it. I don't know why.
Who else cannot see the screen?
I'm unable to see it. I don't know.
Okay.
I think it's from your end.
I'm sure it's from his end. So Shadrach, kindly check. Okay. I'm sure it's from your end. You can quickly go off and come back on quickly so that we continue. Okay. Oh, Shadrach is missing. Shadrach, are you still here? Hello, Shadrach. Okay, let's move on. So purchase commission, broker takes you 1 CD. So you have to take note. Brokers take commission when you are doing your purchasing. So those ones that you are buying on the securities platform, those of you placing orders, they take commission. All right, and there's a selling price in case you are selling at 12 cedis. You bought it at 9 cedis 50 pesos. You are selling at 12 cedis. All right, with the commission, put the dividends involved. The total return includes the dividend. So the investment yielded a return of 23.45. All right, with 23.04 from capital gain. Capital gain alone is 23.04 plus the dividends. It came to added 0.41. So it's the capital gain plus the dividend, accounting for the commissions. After accounting for commissions, so capital gain is a dividend yield is a total return. You can change here. Let's say you earned a commission of 1,000. You see it goes up. Capital gain 23.04. Dividends 2.07. Okay, so when it comes to getting what you earn from an investment is dividend, you don't discount either. It's both of them put together to get what you are looking for. My man, I hope I've answered your question.
Yes, please. Thank you.
You're welcome. Any more questions before I move? You haven't started the beta. I think the time flies very fast. All right, so let me move fast into beta. If you're not able to finish, we'll continue tomorrow. Continue tomorrow. Beta. Okay, so understanding beta. Beta is also part of the component when you're calculating the cost of equity. Right, so I wanted us to also go into beta so that we can break it down to understand. I will share the slides with you. so that in case you still don't understand, you can backstage me, backdoor me a small message so that we can still have a small discussion. All right, give me examples. Let us try our hands on it. So beta, measuring stock risks in Ghana's market. Beta measures how much a stock moves compared to the overall market, essentially quantifying its systematic risks. For GCB, recent calculation, as I showed you, is 1.3. Okay, move. These are the links that we can look at. So this is what beta value tells investors. This is it. So beta, when beta is equal to 1, that means the stock moves exactly with the market. If the Ghana Stock Exchange rises 10%, it means that GCB will also move 10%. So beta equals to 1. That's what it means. It moves in the same way as the market moves. When the beta is greater than 1, that means the stock is riskier, moving more than the market. A beta of 1.3 means if the market moves or the GSE moves 10%, GSE will move 13%. What's this? GCB will move 13%. That means what? 1.3. And when beta is less than 1, that means the stock is less volatile. A beta of 0.5 means if the market moves 10%, GCB will rise 5%. Okay, so it's the same way. So as we have put beta at 1.3 for GCB, right, this is what it means. So it means that when the market moves 10%, GCB will move 13% ahead of the market. Right, beta of 0, it doesn't move with the market. So like fixed income markets, beta of 0. Negative beta is rare, but the stock moves exactly the opposite direction. So when the market goes left, the stock is going right. When is that? That kind of thing. So these are the scenarios for beta. Now, why beta matters for investors? Number 1, it measures risk. A higher beta means more risks, but potentially higher returns. A higher beta. So GCB's beta of 1.3 suggests is sensitive to Ghana's economic swings of the Ghana markets. Okay, investment decisions. If you want stability, pick low beta stocks. So, for example, I did some analysis and I think Extant Chart had a lower beta at around 0.4, so 0.49. So, if you have GCB and Stand Chart in one portfolio, you can say you are fine. So, if you're okay with risks of higher returns, choose high beta stocks. If you're okay, if you want to take risks, you choose GCB, you choose MT. You have higher beta, that is more than 1. Now, calculate cost of equity. Comfort, kindly mute. Comfort, Ashley, kindly mute.
Oh, okay, sorry.
Thank you. To calculate the cost of equity, so beta is a key component of the CAPM that we've been talking about. So you used to find the return shareholders expect. So once you incorporate beta into the cost of equity, we are trying to get the expected return that shareholders are looking for. Now, portfolio building, mix high and low beta stocks and it balances the risks for you. So, for example, parent GCB and Stand Chart, I think I made mention of it earlier on. Now, we come to GCB. In 2025, Ghana's market was recovering from the debt crisis. Banks like GCB have higher betas due to loan default and many other factors, but strong 2025 profits may stabilize a bit over time. And if you can remember, we also mentioned that there was a huge rise in the profits from the 2024 half year to 2025 half year. It rose about 90%, which we also mentioned that it may not be it may be a one-off event that enhance the growth. 90% growth. I don't know which company can keep growing 90 like that, right? So we also know that it's going to stabilize, going to normalize over a period of time. So that means that the high growth in the profits too, whilst it normalizes, beta 2 also has the effect going forward. So we are saying that even though we are saying that strong 2025 profits may stabilize beta over time, it is not expected that the profits will continue to be rising huge like that. It is also going to normalize along the period. For GCB, recent valuation uses as I used 1.3, reflecting banking sector volatility in Ghana's economy, inflation very high, between 12 to 15%. Now, formula for beta. Here's the formula. This is not an academic institution. We want you to practicalize and work. So all the formulas, I'm not expecting that you chew them in your head. We're going to help you with the practical ways to use them. So this is a formula just for your viewing, and also for you to understand. Okay, so I showed you in Excel the formula in Excel. I think is this. So the slope function in calculating for the beta. That's when we got the 1.4. And I also showed you how to get it in the Young Investor calculator. So I want to go over and just show you how to get a beta. Okay, so you see the beta calculator here. Okay, so with this one too, when you put in your figures, everything. So 1, comma space 2, comma space 3, comma space 4, comma space and then 5. This comma has to be close to the figure. Then 10, 20. These are just some scenario figures that I'm giving. 50. Okay. So there's the beta. All right. So you have the two approaches in calculating the beta. Let me go back to what I'm doing. So we are saying that you collect a returns data, gather monthly, weekly returns for GCB and the market. Over. Hello. I can hear you.
Yes, I want to know the comma, the 1, 2, what is the reason behind the separating commas in the numbers? Because it talks about stock returns. But I thought that you are going to estimate or input maybe 1% to one figure. So why the numerous figures with comma?
Okay. Let me do the right scenario so that you will. Hope you can still see the screen. So Shadrach, don't mute there. I just want you to follow. Let's have a conversation. Okay, so the stock returns, as you can see from the Excel. Okay, so these are the prices for GCB at the end of the period 2021, 2022, 2023, 24, and 25. These are the returns. These are the prices. Now I calculated for the returns. In 2020, the price was 4.02. So I calculated for the returns each year. So I'm going to put, these were just examples I was giving, but I'm going to put the real figures so that we can relate better. So it says you list returns in a chronological order from the oldest to the newest. So the oldest here is the return, oldest return is 30.35. 30.35. Put a comma and you bring your space. The next one is minus 24.81. Minus 24.81. You bring your comma and your space. Next one, minus 13.71. Minus 13.71. Bring your comma and you bring space. And the next one, yeah.
I understand that, but do you have to always use several years to do it, or you just use 1 year to do it. As what you are doing is like you are using several years, like in a trend. The stock returns in various years. So when you are
Yeah.
calculating for the beta, would you have to use just 1 year or several years? And if it is several years, how many years would you have to use?
Oh, okay. So for this, you can stick to the years that you are analyzing. So if you are doing for the last 5 years, you can just stick to that period. I keep saying that you don't have to do over 10-year period and all those things. It's not really practical for countries like Ghana. So between 3 to 5 years is fine. But for beta, it's more efficient over a longer period like 5 years. So as you can see on the screen, so you say gather monthly or weekly returns for GCB on the market over 3 to 5 years. Over 3 to 5 years. So you can do a monthly, you can pick it monthly. But what I did was I did it for the end of the year. It is more practical, it's more efficient when you do it the monthly. So I'm teaching you that do the monthly. Okay, monthly end of period returns. Input them. Okay. But if it is too long, it becomes a bit cumbersome. That's why I chose to use the end of year figures. So the end of year figures are what I put in my calculator and even in the Excel. Even in the Excel. So this is it, the calculator in the Excel. I hope it's clear, Shadrach.
Yes.
Okay. All right, so ensure chronological order as we did. Ensure returns from oldest to newest to align stock and market data correctly. And you calculate covariance. Use Excel as I showed you. And alternative approach, Excel, Python, maybe tie the slope. So these two approaches you can use them. Use the Excel, you can use the stock or Young Investor calculator. Example, I think I've gone through the example with you already. Market return and the stock return, where you get your beta value. So where to find beta values? I didn't know Yahoo Finance has a lot of data about the Ghana stock market. So when you visit Yahoo Finance, there's data there, GCB, they have some figures there. So you can pick them from the Bloomberg. It's a one-stop shop for figures on the Ghana market. So there's a beta figures there and all these websites. Okay, all these websites. But we are teaching you how to come by the betas yourself, how to calculate them. Yes. And the beta and the CAPN model. The cost of equity risk-free plus beta. Cost of equity is equal to risk-free plus beta. Then you multiply the ERP. ERP is the equity risk premium. That's the market return minus the risk-free return. So you can just say risk-free plus beta times ERP. Risk-free plus beta times ERP. If you understand what ERP is, you are not, or you are safe. Once you understand what ERP is the premium you are getting when you are investing in stocks, the premium you get from investing in stocks. And how do you get that? That ERP is the market return you take out risk-free. Risk-free is their investment is, for example, treasury rates. Okay, so me that I decide to buy GCB stocks. GCB stocks, what is going to be the return? If the return is 25% and risk-free is about 13%, 25 minus 13 is the ERP. So risk-free plus beta times ERP. That is what we have there, 10 times 1.3 times 15, 29.5. And the factors affecting beta industry, banks like GCB have higher betas due to sensitivity in interest rates and loan defaults. Ghana's inflation also affects beta and the recovery from debt crisis, as we are seeing now. It's also impacting the beta of some of these banks. Company operations, GCB's loan portfolio ties to economic cycles, right? And the leverage, more debt increases beta. So the net borrowing impacts beta values. ECB's beta 1.3, 23.08 as I calculated for, resulting in an intrinsic value of 21 versus market price of 9.54. High beta means ECB is riskier, but offers higher return. Okay, and you have to use the beta to diversify by pairing with low beta stocks, as explained earlier. The limitation is that it assumes past trends predict future risk, which may not hold for Ghana's volatile market, and doesn't capture company-specific risks. So ECB's loan impairments, it doesn't capture it. Okay, short data periods or illiquid markets can skew beta. Okay, so this is the last slide. I think we have learned a lot today. We have learned a lot today. Like the cost of equity. We've broken it down, and a lot of information has been shared. Cost of equity. We have looked at beta. We have looked at the cost of equity itself, proper cost of equity. I would like to pause to take questions. I'll take questions and try to or attempt to answer them. So I'm waiting for your questions. Thank you for having time to come and listen to the presentation. Any questions, please? Adike Salako, if I'm wrong with the presentation, please correct me.
All right, so it's Adeke Salako. All right, my name is Adeke Salako. I'm from Nigeria. I don't have a question. Yeah, so I just want to appreciate you for the very explicit and detailed explanations of all these concepts. From the depth of my heart, I just want to say thank you. Thumbs up, good job. Thank you, sir.
Thank you very much. Thank you very much, Adike. Thanks, Adike. This is all the way from Nigeria. Welcome. And we hope that we will have the impact all across. Any questions, please?
Okay, Kofi.
Yeah, shut up.
Yes. I have one question and one plea. Please, with the dividend payments, now, do these, for instance, the GCD, do they also give data for dividend?
Do they do what? I didn't hear you.
Is there any data?
I beg you. Your voice.
That they have?
Your voice.
Hello. Hello.
Yes. Yes, I can hear you, but it's very faint.
I'm saying that we have data on the dividend that we pay so far over the years, so that we can even use that to measure the growth of dividend payments.
Okay, so from the information I have, 2024, okay, dividends are supposed to be paid this year, but we are waiting for an approval from the BOD. I've seen the publication that shows that it's been approved. The 2 previous years, dividends haven't been paid, or dividends were not announced. So last 2 years, in the previous 2, there was 1. So it's not very consistent. So that's why I keep saying that you guys, for the banks, it's been a difficult period. Dividends haven't really been consistent. So do not use the dividend discount model. Don't use that one. Let's stick to other models to calculate for the intrinsic values. If you use the dividend discount model, you may be getting. Okay, we use the most appropriate model to use for banks and financial institutions is the RM. That's the residual income model. Okay, but we want to start with the
second one is that, I think that for me, going over the various videos has been very helpful, because network issues and all that. And so previous days, I was not very active because of my network. But after watching the videos, I've been able to grab the concept of the
Okay.
analysis.
Thank God. Yeah. Okay. Okay. I can see even now you are struggling with.
I'm playing.
Yeah. Yeah. Connectivity is still a problem as they are even still.
Yes, I've not video, and yes, I pray that they upload the other videos so that we keep on watching. That one will help some of us a lot, and because our working schedule is not so permitting some of us sometimes.
Okay. Okay. No problem. So yesterday's one, I asked that it shouldn't be shared because I knew that it was going to be next. So right after the presentation, Emmanuel is going to share it so that not right after. I mean, he's also doing some other stuff. So I'm sure by close of the day you get it. You have to do some editing before, so you by close of the day. But the slides will be shared.
The Saturday one.
Okay, he's going to share that one too. Saturday he's going to share it. Okay.
It's there. It's on YouTube.
Okay, Shadrach, I hope you are fine now.
Yes, please. Thanks.
Okay. All right. Thank you. Cindy, you asking a question?
Now, I was telling Shadrach that the Saturday on is available. It's on YouTube.
It's on YouTube already. Okay. All right. So I think Emmanuel can just reshare it again. Probably doesn't have it. Any more questions? Any more questions? Okay. So at the K, please go ahead with your question.
Oh, sorry. I guess it's from the last time I should put that answer. Sorry about that.
Okay. All right. Okay. Ahmed, this is your question. Hey, Ahmed, I owe you. Hello.
Yeah, Mr. Kofi, good morning.
Hi, good morning, Ahmed.
All right, so please, I have a couple of questions. The first one has to do with the beta. I want to know if it is possible that maybe a company has a very low beta, but then it can be very risky in Ghana, maybe probably due to liquidity issues or maybe government policies. That's my first question. Then the second one too has to do with beta. You know, some of the companies listed on the Ghana Stock Exchange, they have their parent group, maybe in abroad or something as such. Let's take MTN, for instance, they have MTN Group. So in a situation where MTN Group make a key decisions, can it affect the cost of equity or the beta for the MTN Ghana?
Okay, so you have two questions. I think I don't know whether I got the questions right or not. So MTN Group making a decision that will affect the cost of equity. So if you look at the component of the cost of equity, let's go back and look at it. So look at the cost of equity component. That's the first stop that you can look at. So risk-free rate, beta, market return, risk-free rate, or risk-free rate, beta, and ARP. The only thing that affects or that can impact the whole cost of equity is the beta. That is, so the information coming from the mother company of MTN. If there is a risk that is inherent there, then you can say yes. All right, so beta 2, what are the components? So we are looking at market return and the company return. So if the mother company is making some decisions that will impact the company, so the market return is separate. So these are the components. So what will impact the company MTN? Okay, so is it affecting the profitability? Is it affecting the cash flow? Whichever the impact is coming from, is it going to reflect on the return on the stock market? Okay, so if it's affecting the profitability of the business, then you can be sure that the returns, as we are seeing on the top row, will be affected. Okay, so the decisions that they make, whether positive or negative, is it affecting the cash flow, the bottom line, the top line? These are the issues that you look at. If it does, then you can say the beta will be impacted. If it doesn't, all right, then you can say the beta will not be affected. By extension, not affecting the cost of equity. I hope that one is answered.
Yeah, you've answered that one. Thank you.
You're welcome. But the first one, I don't know whether I got it, but if you can repeat it.
Yes, so I'm asking that, let's say a beta of GCB is 0.5. Can it also be like risky because maybe the government, because of maybe government policies or liquidity issues?
So let's look at this table we have here. So the example you're giving is already in here. So a beta of 0.5, exactly as you said. And the government makes some decisions. So this means that when the market rises, 10%, GC will rise 5%. And you are asking whether government decisions can affect it. Yeah, so I mean, it's a limitation of beta, as we saw in the slides. It doesn't factor in those political risks and all this, but these are risks that can impact the performance of a stock like GCB, because GCB as an institution is exposed to government as well. Government has a lot of shares in it. So if government is making decisions, it affects the institution. And as I explained to you in the earlier slide, if it impacts the profitability, it's going to impact investors' appetite in the business. So whilst you are saying that government has made a decision, is it impacting the bottom line? Yes and no. Is it positive or negative? All those things, they affect the performance on the market. Is it affecting the top line? If yes, is it positive? Is it negative? If no, then no impact. All right. So it's a whole analysis that you need to understand. So let's go. Let's read more. I mean, these things you have to read more. You need to understand. You need to understand the dynamics that go into it. So all of them, it has to come from the basis of the investors' reaction. Investors' reaction. Are they reacting positively or negatively based on whatever is happening with the major stakeholder in the business? Okay. Ahmed.
Yeah, okay. Thank you very much for the answer.
You're welcome. Any more questions? I'll count down. Okay, Esther Akwe.
Yeah, thank you very much. Yeah, so please also, can a stock have a very low beta yet it is risky?
A very low beta. How you define a low beta? So we are saying that these are the dynamics. All right. Stock moves exactly with the market if it's equal to 1. If the beta is equal to 1. If the beta is greater than 1, the stock is riskier, moving more than the market. If the beta is less than 1, that means it's less volatile. So I don't know whether you mean this less than 1 or a little higher than 1, equal to 1. There's none like equal to 0, which is because it's just to fixed income securities. Negative, which is rare. So I don't know where or which aspect of this you want to place your question. Can you be more specific, Esther?
So you made mention that the higher the beta, the higher the risk, right?
Yes.
And I want to know, can it be the opposite way? I mean, the beta is low, but then the stock is riskier. Is it possible for it to happen that way?
Okay, so it's possible. It's possible that way, but for us, we want to focus on the figures as we can see. All right. So we want a situation where when you meet the investor, you're able to pinpoint that this is the reason why the beta is high. So, for example, if GCB, for example, if you're asked why is it 1.4, you can easily say, I checked the market returns over the last 5 years, and that is why the beta is so high. Okay, but if the beta is very low, okay, beta is very low, there's a stock which, okay, so I give an example of StanChart. StanChart is a very quiet bank. It has a beta of this is 0.49. Okay, so if you are blending a high beta stock like MTN GCB, you can add a StanChart to it because the blends are different. If 0.49 is at 0.49, MTN is at let's say 1.3, GCB is at 1.4. Putting these stocks together, even though you have two stocks that are very volatile as the market, you can have one that can also stomach this kind of risk. It's a very stable stock. All right, like StanChart. All right. Okay, so StanChart, the beta is low. It doesn't move doesn't move like the way the market will move. It can be stable for over a long period, but when it starts going up, it is very profitable. So that's an example I can give. I don't know whether I've answered the question. Maybe your question has to go to the higher court, but I think I've tried. Or
Oh yeah, you have.
I've tried. Okay. All right.
Thank you.
You're welcome. Any more questions? Okay, so thank you very much. We'll meet again tomorrow. Tomorrow we'll move into another level of the evaluation. Okay, we'll move into another level of the evaluation. Now we know what beta is, we know what cost of equity is. So we'll go into the FCFA proper so that it can help all of us. Thank you all for joining. Have a beautiful day.
Have a beautiful day too.
Thank you. Have a great day too.
Thanks.